Hey everyone, Chris Haddon, Jason Balin, co-founders of Hard Money Bankers. Check us out at hardmoneybankers.com and Facebook/Hard Money Bankers. Today we are talking about what real estate investors can learn from Warren Buffett's business.
We go through some key takeaways relevant to all real estate investors, especially things related to your bottom line profit, execution, and acquiring assets. Check it out right now.
So Jason and I have been working our way through Warren Buffett's book. It's actually not his book, it's a book about Warren Buffett called The Snowball and the Business of Life. I finished it about a month ago, a few weeks ago. I don't know, on the iPad, maybe 900 some pages. It took me a couple months, like it was a bear, but it was awesome.
Yeah, I got about 19 hours left listening to it on Audible. 19 hours out of 40 plus hours of the book, but you know, it's an easy read. It just obviously takes a lot of time to get through, and
it's not a tough read. It's not a tough read.
And there's a lot of things pretty much on a regular basis that we talk to about each other with some other business partners and some of our staff members. Just like aha moments that we've gotten out of him.
Totally.
I mean, the guy is ridiculous, and there's just a lot of things that you can really relate in his business to our businesses inside the lending side and inside real estate investing side.
For sure.
You know, that we've got out of it.
Yeah, and I mean, yeah, like you were saying, there's just so many aha moments that we want to talk about, that we want to write down, that we want to jump on camera and shoot a show about. So that's what we are doing. There's going to be some really, really good stuff related to real estate. Let's dive right in. Number one's an easy one for us because we talk about this a lot, and we're going to keep hammering it home on different videos because it's that important, is that the bottom line in real estate or whatever venture you're into speaks the loudest. That's the most important thing. The bottom line's got to be there, or else everything else crumbles.
That's right.
Right. We talk about that one a lot, so we don't have to go too deep on that.
The bottom line meaning money, of course.
The bottom line meaning your profit, your bottom line profit.
Not doing deals just to do deals, and not be kind of role playing just to be associated with the business. But you need to make sure your bottom line of making the dollars associated with your business and associated with your real estate deals, because if those dollars aren't there, it's short lived.
Yep.
Very simple, but in that book, it goes back to every few sentences related to how he is to just make sure every penny that's involved in his businesses are watched and taken very seriously. And a big part of that is, he picked this up from the early stages of his book. The way Warren Buffett looked at every dollar was being worth $10. So for every dollar that
can't spend $1, it's going to be worth 10 in the
exactly.
future.
He knew that with snowballing and appreciation, and everything else, compounding interest, that every dollar that he had or every dollar that he could have would be worth $10. And when he was looking at that in the 50s and the 60s, it's probably worth significantly more than that now. Yeah. But that was just the way he looked at stuff, and you learn a lot from that.
No, almost nobody has that. I wish I could just inject that idea into my son.
Because you're like, hey, $100, like so be it. But $100 is really $1,000, and $1,000 really is $10,000, and more and more. Cool.
Real quick before we move on, famous quotes from Buffett, or one quote is, speaks to this too, which is, rule number one in investing is never lose money, and rule number two is see rule number one.
That's right.
Yep. So there we go. Next, this is another interesting one that it surprised me a little bit when I was reading the book, is that when Buffett was getting into deals, investment deals, starting out they were relatively small, and then they grew to be gigantic. But throughout the whole process, he was in essence obsessed with two parts of any transaction. One is the investment itself, which we'll call the horse, and the other one is the partner or the operator, which we call the jockey. So the horse and the jockey. And he, going through all these big deals over the years, over many, many years, was very, very much obsessed with both. In essence, you need both. A business model or an investment itself is not going to do it for you, and a good operator without the right business model is not going to do it for you. You absolutely need both. And it surprised me to see that he was so good at people.
Yeah.
He's very bad in some ways
Exactly.
regarding people, but very good in others.
So clearly real estate's a good investment if no matter what side you're on, if you're on flipping houses, buying rentals, wholesaling, whatever the case is, the horse is there and it's great. So now it's up to you to become a good jockey or surround yourself with good jockeys, partners, operators, executors, because the business model is here. The business model has always been here. It's going to be there in the future. And there's a lot of benefit from owning and doing stuff with real estate. So just make sure you can execute on that. That's the good takeaway from that.
Yep. Moving on. There's something unique about real estate and certain other businesses that are like Warren's in that this is, an important thing and something that's rare. The fundamental function of real estate, like Warren's businesses, is acquiring assets. And most businesses are not like that. If you're a lawyer, if you're a consultant, if you're a dentist, if you're whatever, you are earning fees. People pay you money to do a service for them. And that is radically different than making the function of your business to acquire assets. Because after years and years of doing money, doing work for fees, which is fine, fees pay the bills, fees are cool. I love fees. If anyone wants to give me a fee, I will take it.
Yep.
But what is built at the end of a run, X amount of years, may or may not be something very special at all. Whereas the few businesses where the function of those businesses is acquiring and holding and growing assets, what you have at the end of the road is huge and ridiculous. And that's a crazy fundamental thing that I don't think I've always been aware of.
Yeah, and keep in mind that part of his book that he talks about a lot is he was getting fees from his partnerships on deals because he needed the fees, he needs the income, he needed the cash flow that would come into that. But after it got to a point that he had all his bills covered and everything else was rolled back into the partnerships, rolled back into the businesses.
Right.
And you can relate that to real estate very easily. Obviously, if you're going to flip a house and make 20 or 30 grand, you need that. You need that fee from that. It's short-lived because it's one transaction. That's it. But as that works, you take some of that money, you put that aside, and then you roll that into your next project, and you roll that into your next project, then you acquire some rental properties. And over time, you treat it as a real business that grows itself and produces income kind of while you're sleeping, just so you're not moving from one project to the next, to the next, to the next, because it's great to make good income on that, but it's not leveraging up or compounding your interest to the next deal, to the next deal, to the next deal. And some of the things that we work on, obviously when we do loans, we get fees from loans, and when the loan gets paid off, that income stream for that individual loan's over. But over time, you build a portfolio of a lot of deals that you have, or you buy a bunch of rental properties, and those are. So you're diversifying into lots of different things, and real estate is one vehicle out of a lot of different business models that works great for this compared to a lot of other friends' businesses that we know.
Absolutely. It's a rare thing, and it's something that if you're in real estate and you're not taking advantage of the asset side of things, you really need to reevaluate that. Yep. Cool. Okay. Something else that comes up a lot in real estate, and this goes back to the bottom line profit thing we mentioned at the beginning, is that you have to be very, very careful about your emotions and your discipline surrounding deals. It happens all the time with newer investors that they have a property or a couple properties that they're obsessed with buying to the point that they get emotional about the transaction. Even if the numbers change, even if whatever happens, even if that offer price goes up, they still want to buy it because of emotions. And that's a very, very dangerous thing. It's a dangerous thing to chase a deal up the ladder of purchase price just because you're zeroed in on buying it. Having that discipline, passing on a number, like you mentioned a story earlier about Buffett is negotiating techniques. How did that go?
His whole setup was, number one, he was smart. He used real data to voice an opinion, but he also had his instinct take over to determine if this worked or if it doesn't work. And even if some of the data didn't support it, he'd still go with his gut and say, this doesn't 100% meet my model, but this is, this is why. But the story we were getting at was he had a guy that he came to buy that wanted to sell shares to him, and he said, sure, this is my price. And he's like, okay, cool. Let me go back to my to my people. Let me see. And keep in mind, Buffett only negotiated with the decision maker, and just like any real estate investor should do as well. Make sure the person you're pitching and you're talking to, the seller, is the person that can make the decision. So anyways, he knew very well that he didn't really have to go back to anybody, but the guy did anyways, and he came back and, hey, sorry, the deal's lower now. Deal's up deals off the table. Like, that didn't work for me at this time. And he kind of went back and forth. And he wasn't necessarily playing games. I mean, Buffett seemed to be a pretty honest guy and a good businessman. But at the same time, you know, it was business, right? It wasn't.
It was discipline too.
It wasn't personal.
Like he wasn't obsessed with buying whatever asset it was, so he's going to chase it to any price.
Exactly.
Like, he had his window of a good buy price and he stuck to it. A lot of discipline goes into that, especially when you do need to acquire stuff. You do need to put your money to work. You do need to do deals.
And where it's hard for real estate investors is when we're in a market that it's hard to find good deals at, and you know, they're endlessly chasing them around and saying, you know what, this one's not perfect, but it's good enough, I'm going to do it. And you know, you got to stay disciplined on it and do your thing.
Good stuff. All right, so we're going to keep, I finished a book recently, Jason's going to be there soon, and I think there's going to be more stuff to go over. I think we could do another Buffett focused. I mean, it's worth its weight in gold, it really is. That book, which was the equivalent of like a high school semester-long course, no joke, was absolutely worth it. Well, and much more valuable than many semester-long courses for business.
And it works for every business. We're just tailoring it towards real estate because it's what applies best to us. But you know, and he nothing in there talked about, you know, buying commercial properties or buying rental properties or anything. It had nothing to do with that. It was just, you know, him and the way that he, you know, followed a few of his key principles.
Good stuff. Guys, thanks for checking us out, and we will see you next time.